welcome, man.
Thank you for having me. I appreciate it. This is fun.
Thank you so much for coming. And actually, Morgan Housel is the author of this book that is called The Psychology of Money. This book sold alone worldwide more than 1 million copies until today. And I told Morgan that I think this book will sell more than 10 million copies in a few years. Let's hope it happens.
No pressure.
Do you believe it will happen?
Fingers crossed. I have low expectations, but I hope for the best.
Okay, so Morgan, thank you so much. We have a huge audience in Brazil, and we all love your book, love the way you think.
Thank you.
And I'm very curious about your philosophy of investment. And first of all, I would like to ask you, will you tell us the truth today?
I always tell the truth. Yes, I will tell you the truth today.
Okay.
But it's a good point because so many people in finance tell you what you want to hear, even if it's not the truth. A lot of the times the truth is messy or it's hard to hear. And so many people in this industry tell you what you want to hear.
So it happens even in the US?
Oh yeah, all the time. Everyone on TV, people who are selling you something, they tell you what you want to hear, what sounds good, what you want to believe, even though the truth in investing in finance is often kind of painful and it kind of hurts, and you got to be willing to put in a little bit of effort to get it. So the truth can be painful, but I promise to tell you the truth today.
Okay, so let me ask you the first question to Morgan. Morgan, how do you invest your money?
My broad investing philosophy is I'm a passive long-term investor, and I want to earn the passive returns over the next 50 years. And here's the thing, if I can earn average returns for an above average period of time, I will achieve extraordinary returns. I'm highly confident in that. Most investors want to earn above average returns for a below average period of time. That's their goal. I just flip that around. The reason that is because if you understand how compounding works, how compound interest works, the biggest variable, the rocket fuel of compounding is time. So I want to maximize for time. So rather than saying what are the highest returns I can earn, I want to answer the question, what are decent returns that I can earn for the longest period of time? And when you are a passive investor, it increases the odds that you can actually be an investor for 50 years. Because if you are trying to make a really complicated investing strategy, you might earn better returns in the short run. And by short run, I mean even 5 or 10 years into the future. But it increases the odds that you're going to make a mistake, that your investing strategy needs to change, that you're going to become stubborn with it. It increases the odds of not being able to stick with it. Charlie Munger has this great quote where he says, the first rule of compounding is to never interrupt it unnecessarily. And I love that. For me, it's just, I just want to earn uninterrupted compounding returns for the rest of my life. And if I can do that, I will achieve every goal that I have and then some. So it's all passive. It's pretty much all in Vanguard, nothing fancy, as boring as it gets. And that's how I like it.
Okay, so I'll probably make some questions for you in a moment about your philosophy of investments. But before making them, I would like to know how do you distribute your portfolio? So you have 100% on your portfolio, and inside this 100%, how do you distribute and divide your money here?
I'm a little bit different than most people on this. Rather than saying I'm going to have 60% in stocks and 40% in bonds, I do it by dollars, basically. So I say I want to have X dollars in cash. This is the number of dollars that I want in cash that will make me feel safe to take care of my family, to prepare for emergencies. And once I have that, everything else goes in stocks.
But what is the rationale of it? So how do you set a goal of how much dollars do I need to have in cash, for example?
There's really no science behind it. It's just, what do I need to feel comfortable to sleep well at night, to say, if there was a medical emergency or something bad happened in my career, if there was a big emergency in my family, if there's a big recession, whatever it might be, how much cash do I need in the bank so I can be like, that's enough, that's plenty. There's no science behind it. It's just kind of a feeling of like, that makes me feel comfortable. I could live X number of months or years on just this cash, and that makes me feel good. And once that is achieved, every other penny, everything else goes into stocks. And I don't even dollar cost average. It's just whenever I get any cash laying around, boom, it all goes into stocks.
So in your case, how many months do you feel it's good before thinking about investing long term?
It changes for everyone, and it's changed for me over time. I would have given you a different answer 5 or 10 years ago than I would today, because I have young kids now, because my wife is at home, and it's kind of, I'm the breadwinner now, so it's changed over time. Years ago, it was 6 or 12 months, and that would be like, that was adequate to me. Now it's pushed up to several years of living expenses, which I would say is excessive. It's not. I'm not even recommending other people do that, to have several years of living expenses set aside. That's not really necessary. I do it because, well, for two reasons. One, I know that myself, just understanding my personality, I'm more prone to worst case scenario thinking than most people. I'm more wired to be a little bit paranoid about economic collapse and whatnot, and that's just my personality. It's just who I am. So I want a little more because of that. The other thing I think is important, that this applies to everyone, is that the biggest risk in the economy is always what no one is talking about or no one is thinking about. We learned this with COVID. For the last 10 years, no one who was talking about economic risks, no one said the biggest risk is a virus that's going to shut down the global economy. No one was talking about that. The biggest risk is always what you don't see coming. And because of that, if you are only preparing for the financial risks that you can foresee, by definition, you're going to miss the biggest risk. That's going to be the surprise. So I think everyone should have a level of liquidity and safety in their finances that seems excessive, because that's when you know you are prepared for the risks that you cannot even think about, that you can't foresee.
Yes. I'm not sure if I remember it correctly, but when we were shooting with Howard Marks, he said something like, the absence of risk is the greatest risk.
That's it. That's
something
it.
like that, right?
Carl Richards, who's a financial advisor, he has a quote that I love. He says, risk is what is left over when you think you've thought of everything. After you've planned for all the risk and you think you're thinking about the future, real risk is what's left over that's not on that list.
Yeah. Let me ask you something. You said that if I asked this question for you like 5 or 10 years ago, your answer would be very different.
Yeah.
But nowadays you have some years in advance invested in liquidity and something very secure that you can take out the moment you want. But do you think it's related to your mindset, or for example the level of money you have today? Because nowadays you're making more money than you used to make. So do you think it's related also?
That's a good question.
Or it's a behavioral type of thing?
I think that's such a good question that I haven't thought much about. I would say 80% of it is my family situation. We got young kids. They rely on me for support. It's a different phase of my life. 20% is probably higher income, and hey, now I can save a little bit more. So maybe 5 years ago I would have wanted to if I could. But now that I can, I'm like, yeah, let's do that. I also have to acknowledge, too, that there might become a point 5 or 10 years in the future where I say that's too much and I want less cash, or I want even more for whatever reason. Everyone's always changing, going through phases of their lives. So rather than like being really stubborn on like, this is my financial plan and I'm sticking to it, that might seem like a good, noble cause. But I think everyone changes, and you just need to embrace how you change over life. So I might give you a different answer 5 years from now.
Okay, let me ask you two things. About this money, where do you invest this money?
The cash that I have?
Yeah, the cash.
In the United States, we have what are called high interest checking accounts, which are, there's just like a checking account. It's what's called FDIC insured, which means the government insures it.
FDIC.
FDIC, Federal Deposit Insurance Corporation. All that means is that if the bank fails, the government will insure your deposits. So you really can't lose money on those, even if the bank goes out of business.
And what are the returns of that?
Very low. Half of 1%. Very low.
Half of 1%.
Half of 1%.
Wow, it's crazy.
It's very different in Brazil. But our inflation rate is lower than yours too. But even still, half of 1%, and the inflation rate in America right now is 6%. That's the highest it's been in a while. So you're losing money after inflation, for sure. I'm actually okay with that, because I feel like the cash that you own is an insurance policy. And just like if you pay insurance on a house, you don't feel like you're losing money. You just feel like, look, it's worth it to protect against the risk of catastrophic loss. So look, at the 6% inflation and 0.5% interest, that's a big loss. I hope it doesn't stay at that level for a while, but
maybe this is something temporary, because last year it wasn't 6%.
No, I mean, for the last couple of years, it's been 2 or 3. So it's a smaller, much smaller loss then. And if inflation stays at 6%, then I would imagine the interest rate will go up to compensate for a little bit. But I'm actually okay with a very small real loss on the cash that I have, because I view it, that's just like paying the insurance premium.
Okay. Do you know how much percent this represents in your portfolio?
As a total, my total net worth.
Or is it irrelevant?
It's small. It's small. Single-digit percentage points. Yeah.
Okay. Okay, you have this cash you have for for the purpose of sleeping well.
Yeah.
I can say. And besides that, what else do you invest?
Well, here's what I also say about the cash. Not only is it for sleeping well, but it would be that if there was a giant market collapse and the stock market fell 50% or something, I would have ample cash to invest in those opportunities. There's a really great book called The Great Depression, A Diary. And it was written by a lawyer named Benjamin Roth who kept a diary during the Great Depression.
A diary?
A diary. He was just writing about what was going on in the 1930s. And one of the things he writes about is that in the 1930s, when the market fell 90%, the stock market fell 90%, he wrote that everyone knew that the stock market was cheap. Everyone knew it was a good value. Nobody had any cash. Same thing with real estate. Everyone knew that real estate was a great investment. No one had the cash to invest in it. So if you have what seems like a crazy amount of cash sitting by when the market is high, like it is right now, that actually might be the most valuable asset you own when the market collapses, and you can actually go in and pick up those values. And so many of the great financial fortunes over time come from that, come from people that step in when the market is collapsed and buy up real estate, buy up junk bonds when no one else wants them. So that's the other part of the cash.
Yeah, I agree with you totally. Myself, I have some money invested because of this. And one part of it is because I want to buy things cheap when nobody else had the money, only me. And the second part is because I like sleeping well during the crisis, because we tend to be very nervous between crises, and I want to be very calm and take the right decisions between a crisis. Okay, besides this money, what else do you invest your money?
Basically, all the rest goes into Vanguard index funds, mostly U.S.
But how do you distribute it?
It's the vast majority is a Vanguard Total Stock Market Index, which is just owns basically every U.S. public company. Now, in America,
but like almost 100% of your money in that, or do you?
The vast majority. There's some else in like a Vanguard Value Fund and international funds, but the big majority of it is Total Stock Market Index, which just owns every company.
If you take your 100%, how much percent do you put on that?
80% of the stocks that I own are in that. Yeah. And that just owns every company. And it's called market capitalization weighted, which means that the biggest companies in the index are the biggest holdings are the biggest companies in America. So if you look at that index, a big chunk of it, 25% or something like that, is Tesla, Amazon, Apple, Microsoft, Google. That's a disproportionate share of the index. So the big companies make up even though it's a very diversified index, it's heavily weighted towards the big names.
Okay, so if you think about your 100%, 80% of your money you invest on this ETF, the market capitalization weighted via Vanguard.
Yep.
Okay. And why do you do that?
I do that just because it's, again, like going back to if you keep it simple, you increase the odds of being able to stick with it for the longest period of time. Okay. So for me, it's just what is the simplest investing strategy that I don't need to put any thought into. I don't need to track like how the industries are doing on a quarterly basis. I don't need to track like quarterly earnings or anything like that. It's just completely brainless. Just put it in there and leave it alone for 50 years. That's my whole goal. And here's what's important. I'm a passive investor, but I'm not the kind of passive investor that says, no one can beat the market, don't even try, it's a waste of time. Those people exist, but I'm not one of those people. I think there are a lot of smart investors who have and can and will continue to beat the market. So then the question is, why don't I invest with them? Why do I want to be passive if I think other people can beat the market? And the answer to me is, again, like, if I keep it simple, it increases the odds that I can stick with it for the longest period of time. And there might be fund managers out there that I could invest with today that will earn a higher return this year or next year, but I think it increases the odds that I won't be able to stick with them for the long run. Maybe like 5 years from now, I'll question their abilities, they'll go through a rough patch and I'll want to sell and pull it out. Whereas if I keep it simple, it's just all I got to do, I focus all of my attention on endurance, because endurance is really where compounding works. So that's why I'm a passive investor.
This is very curious because if you get all the Americans, how many Americans do we have here?
330 million.
330 million, okay. Yeah. When you think about the 330 million people, and when you think about the average of the market, you have most of them that don't have the time, the will, maybe the rational ability to think about stocks.
Yeah.
And you talk about finance almost every day, you study finance almost every day, you teach about finance.
Yeah.
And even though you make all of this, like on a daily basis, you prefer to invest passively.
I think some of that just might be my personality, that I like the simplicity of it. I have almost no susceptibility to FOMO, fear of missing out. It's just like, it does not bother me in the slightest that other people might be earning higher returns than me this year or over the next 2 years. That doesn't bother me at all. Other people it would, but I'm honestly okay with it. Because if I can, again, average returns for an above average period of time, leads to extraordinary results. And if you can be a passive investor and leave it alone for 50 years, you will find yourself in the top like 1% of all investors. And that's good enough for me. If I can end my life in the top 1% of all investors, like, great, you win. That's how I think about it.
What is the ticker of this ETF?
VTI.
VTI.
Yep.
Okay, so something around 80% in VTI, some single digit in FDIC.
So FDIC is the cash, and FDIC is the insurance policy provided by the U.S. government that protects your cash if the bank fails.
It's like in Brazil we call it FGC. Okay.
Yes.
So this is what protects you.
Yep.
But the name of this investment is?
Well, I have mine in a bank. I won't tell you the name because we get sensitive about our stuff. But basically, any U.S. bank will provide that kind of high interest savings account. Yeah.
A high interest savings account. Okay, so this is a high interest savings.
And the returns that you can earn, like 0.5%.
It depends from a bank to another bank?
Yes, and 0.5% is about as high as you can find today. Those returns too are pretty comparable with what you would get from like short-term bonds. So even if you're investing in short-term treasury bonds or something like that, it's basically the same returns. And it's so much easier to do this rather than buying and selling a bond, just have it in a savings account.
So we have almost 20% left.
Something like that. For me, that would be real estate, the value of my house. Yeah, that's it. Yeah. And I don't have a mortgage. I write about this. I don't have a mortgage on my house, which is a very intentional decision of like, that's a terrible financial decision because you can borrow so cheaply in America. You can get a 30-year fixed rate mortgage for 3.5% or lower sometimes.
Less than inflation.
Less than inflation. So it's a terrible idea to pay off your mortgage. But we did it because I like to sleep at night. That's it. To me, like the purpose of money is to give yourself a better life. It's not to like maximize the spreadsheet. It's not to make the spreadsheet happy. To me, it's just like, what can you do with your money to give yourself a better life? And I decided years ago that I would be a little bit happier and feel secure with my young kids if it was just like, oh, this is our house. No one can take this from us. This is all ours. That would make me happy. So I went and did it. Yeah. I knew at the time that that was a terrible financial decision and that I would lose money relative to what I could have earned in the stock market. I knew it then, and it's turned out to be very true. Like, I know how much I've lost by if I had taken that money and invested in the market. I know how much I've lost. It honestly does not bother me. As I knew at the time that was going to be the case. Okay. It doesn't bother me because the pleasure that my wife and I get from knowing that this is our house. Like whatever happens, my career implodes, whatever it might be, this is our house for our kids, it's all set. That is so important to us that I like it. I always say with this stuff too, I'm not recommending anyone do that. I'm not saying it's a good decision. All I would recommend is that you figure out how you can use your own money to give yourself a better life. And that's going to differ from person to person. There are a lot of people in America or watching this right now for whom if they did my financial plan for them, it would be a terrible decision because it wouldn't match their personality. They would want to take more risk. They should be taking more risk. I think that's great. Too often in finance, we have this idea that like there's one way to manage your money. There's one right way that everyone should do. And it's just not the case. Like my personality is different from yours, which is different from everyone else's watching. And everyone just needs to find whatever works for them and do that. So I'm not recommending that anyone in particular follows what I do.
And it's very interesting hearing you say it because I imagine now a lot of people commenting things like, I would improve his way of investing, doing this or that.
They're totally right.
But it's like the history of the fisherman we were talking before.
Yes.
That we would do a lot of improvements to actually be free and do whatever we want.
100%.
But we're already doing it.
What I want to do in life is spend all my time reading books and talking to my friends and hanging out with my kids, and that's it. That's what I aspire to do. So in terms of like taking more risk with my money to get more, it's kind of like I've already checked a lot of the boxes. But it's also not that like I don't want to earn higher returns. Is that I know that if I can have an investing strategy that is so simple and so basic that it increases the odds of sticking with it forever, that actually will lead to the highest returns. Okay. And that's why if you can be a passive investor for a long period of time, you will find yourself among the top 10% of all investors. So it's actually like over time, it actually is the way to maximize wealth.
Okay, very good. Do you have other ETFs?
I have, in smaller amounts, Vanguard International Fund and some value funds, but they're much smaller amounts. The thing about in America is that even if you own just US stocks, so many of those companies do so much of their business overseas. If you own Apple stock's getting a tremendous amount of their revenue from China and Europe and South America and whatnot. So it's an international company by default. So even if you're only investing in American stocks, like half of that revenue is international. So you kind of are an international investor by default.
Okay. Just so I can write here, you said you have some Vanguard International?
Yeah.
What is the ticker?
VXUS.
VXUS?
Which means Vanguard International excluding the United States. Everything except America.
Okay, makes sense. Do you know how much percent do you have of it? Like 1%, 2%, or something like that?
10% of the stocks I own, something like that. Yeah.
Okay, so almost 10% here, and you said something
the
about
rest is a value fund, VTV,
value fund.
right?
Okay.
I've been buying that lately because everything else seems crazy expensive.
Okay.
So I thought, we'll put it in value stocks.
So it's something like 80% VTI, 10% international X US, and some VTV.
That's it.
For value.
I would also say too, I don't try to become a scientist to like maximize like what's the perfect ratio. It's just kind of like
rebalance your portfolio.
No, because the cash I have is just the dollar amount. It's not a percentage terms. It's just once I have this many dollars, I've checked that box, and then everything else goes into stocks.
Like when you get more money, what do you do with your money? You invest in where? What is the logic of it?
Recently, it's been in the value fund just because it seems everything's crazy high right now, crazy expensive. And honestly, the difference between VTI and the value fund is it's not that much. They all have a high correlation to one another. But I just started putting things in that just off of the idea that everything's pretty expensive right now. But it honestly does not make that much difference which one you own.
Okay. What is the first more basic and more important principle that you would recommend people to follow when they start investing their money?
I'll give you two. The first one that I mentioned is you got to figure out what works for you. Even if it's the wrong answer that doesn't make sense on the spreadsheet, a subpar investing strategy that you can stick with is always going to beat a perfect strategy that you are going to get scared out of or sell one day. So you got to figure out who you are. The second is don't overlook how important time is in your long-term wealth. That's the single most important variable. And again, a subpar investing strategy for a long period of time is always going to beat a perfect investing strategy that you can only hold for a year or two. That's always going to be the case.
Two questions. The first one, how do I figure out what is the best strategy for me?
A lot of people, it's hard. The only way you can do it is by having some personal history as an investor and looking back. People, everyone, including myself, tends to be a very poor judge of what their own risk tolerance is. And it's easy for me sitting here today to say my risk tolerance would be is this, and if the market fell, it wouldn't bother me. It's not until you actually experience the market falling 30% that you're like, oh, that's who I am. I actually didn't know that's who I was, and that's how I would react, but that's how it is. So people are poor judges of it. So what you need is just look back at your history as an investor once you've built up some history and say, how did I respond in March of 2020 when COVID was ruining the global economy, or 2008 or 2001? What did I do back then? And that's the best indication of what you're likely to do in the future. So that's how you figure out who you are as an investor, is just observing your own personal history with the idea that you're actually not a very good judge if you're looking ahead. You have to look back at what you did. At the personal finance level, I think it's just kind of figuring out what kind of life you want to live and understanding your own personality. I will admit for the 10th time, my investing strategy is not optimal. I'm not optimizing for earning the highest returns. I want to optimize for giving myself and my family the best, happiest life that we can have. And this optimizes it for us. But it might be different for other people.
Last question I forgot to ask you. Do you have something in cryptos?
I don't own any, but I would not bet against any either. I'm not anti-crypto at all. I just watch as a fascinated observer of what's going on. 5 or 10 years ago, it would have been easy to say the history of cryptos is very uncertain, to put it lightly. Today, you have to acknowledge that if enough people believe something is true, it becomes true in its own way. And enough people believe in Bitcoin and other cryptos today to give it long-term value, I think. That doesn't mean that the price can't fall 90% like it has in the past, but so many people believe in it, and so many people are the smartest minds of their generation, and so much capital is going into the innovation in the crypto sector that you can't bet against it in the slightest. Now, there's a long history of what happens during big periods of innovation, which is that there's tons of new companies, tons of new entrances, and after 5 or 10 or 20 years, it gets whittled down to 2 or 3. In the early 1900s, there were 2,000 car companies in America. And 20 years later, there were 3, General Motors, Ford, and Chrysler. Same with computers in the 1980s, internet in the 1990s. Like, there were tons of search engines in 1990s, Ask Jeeves and Hotbot, like all these different search engines. And now there's one, Google. And so it's easier to see where a trend is going than it is to actually know what to bet on for the long term. That's a completely different thing. And that's why for me, again, just being passive, like all I focus on is compounding. It's fascinating to watch. And since I'm not really susceptible to FOMO, it doesn't really bother me that much. But it's incredible what's happened. I mean, there's trillions of dollars in the area right now for an industry that did not exist in any given way 10 years ago. Like, I don't think there's ever been as much wealth creation in that short a period of time for a completely new industry, ever. And there might not be ever again. It's like the fastest wealth creation that we've ever seen.
Yeah. So from the 100% of your portfolio, you have some of it in high interest savings account, the money that lets you sleep well and maybe enjoy some good opportunities. You have almost 80% invested in stocks through ETF, through the VTI. In Vanguard, you have maybe some 10% on VX US, so Vanguard International, and some almost 10% on VTV of value stocks, and you have your house.
That's it. I like keeping it that simple.
Simple.
I can tally up my net worth and where everything is in 2 seconds in my head, and I like keeping it simple like that.
Okay, and now I want you to sign this book for me.
I'm gonna do it. Let's do it.
It's TH, don't forget the H.
TH.
Yeah, Tiago. Thank you so much.
Here we go, sir.
Yeah, thank you so much. Guys, you should read his book if you didn't yet. And I can say this is one of the best finance books I have ever read. Yeah.
Thank you.
This is not because you're here, because I talk about this every time in Brazil. And hope you come to Brazil anytime.
I'd love to.
Hope to introduce you to Brazil soon. And the last question is, I'm not sure why, but the cousins here, they don't click on the like button when I say them to do that. So maybe if
I'll do
you
it.
do that, yeah.
Don't forget to like and subscribe.
Yeah. Now you are intimated to do that. Thank you so much. And Morgan, how can the cousins find you in the social networks?
Most of where I spend my time is Twitter. My handle is Morgan Housel, my first and last name. That's my social media of choice. I know you're everywhere else. I'm pretty much only on Twitter.
Okay. But follow him on Instagram also, because he will start producing content on Instagram and you'll see. Thank you.